This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, markets this week reached an inflection point. On one hand, there's the bright and prosperous future world full of data centres, GPU computer chips and generative artificial intelligence. But there are also real concerns about the amount of money being spent to get to that bright new future and whether it will ever be repaid. Today, we'll hear from the Nvidia CEO Jensen Huang and Australia's leading tech investor.
People are starting to sort of, their hair's on fire about whether the capex of $1 trillion is going to be serviced by the revenue that comes in. And everyone's kind of going, it's just all getting too hard right now. I don't know what to think about this.
And the other concern for markets is the future direction of interest rates. It's not just here where a supposed string of interest rate cuts is now in doubt, but in America as well. The problem is a lack of productivity, now a handbrake on how fast our economy can grow. And that's a rising problem for the Albanese government.
The answer is, well, productivity is weak, so we just can't deliver enough supply to meet stronger demand. And that's showing through in the inflation numbers we got.
Plus, the world's airlines are all gearing up for non-stop travel to every corner of the earth. It doesn't matter whether it's Qantas, Middle Eastern Airlines, not the least being a new luxury national carrier called Riyadh Air. Well, today we speak with the chief executive of one of the world's biggest airlines, Cathay Pacific, which is also expanding fast to win its share of global travel.
And over the last 3 years, actually, we've committed well over 100 billion Hong Kong dollar into the future in building the Hong Kong International Aviation Hub.
So all that and plenty more coming up on today's program. But look, let's start this week with our economy. And the International Monetary Fund this week laid down a challenge to our government to impose more budget discipline and to reform the tax system. But don't hold your breath.
It's not unusual for the IMF to put forward different ideas, and it's not unusual for the government to say we don't agree with all of them. We don't agree with all of the proposals put forward in the IMF report around the GST or some of these other tax matters, but we are cutting income taxes 3 times. We are introducing a standard deduction to provide a little bit more relief, but also to simplify the system.
Well, the Treasurer, and there's no surprise here, he's a master at it, he spun the report as an endorsement of the government's policies. Now, it is a fact reforming the economy. That's what he said. The truth is it's doing nothing of the sort. The government's willingness, and for this read the Prime Minister's willingness to genuinely reform the economy has created a handbrake on our ability to afford the government's spending in other areas of social reform. The problem, as the IMF clearly points out, is that Australia's forcing upon itself lower than normal rates of economic growth and potentially higher inflation. So in other words, if there's no interest rate cuts in the near term, question the government about why it can't improve productivity and pick up economic growth. That answer goes straight back to the lack of will to reform and to potentially make political enemies by rewarding companies and individuals who actually create economic growth here in Australia. Progressive socialism, you see, has a price, and we're right now all paying for that. Paul Bloxham is the chief economist at HSBC in Australia for years. He's urged governments of all persuasions to reform, to change the dynamics of our economy, along with the perils of doing nothing. And I spoke with him earlier.
I think we're growing as fast as we can grow at the moment, and it's not particularly strong. I mean, growth is not particularly strong. The GDP print we got told us we're running at a little bit below 2%, but that may very well be close to the maximum pace that the economy can grow. And the answer is, well, productivity is weak, so we just can't deliver enough supply to meet stronger demand. And that's showing through in the inflation numbers we got. I mean, inflation picking up again before we've even had much of a recovery is a sign that the supply side and productivity is the challenge.
OK, so then what that says, though, is government spending has continued to grow much, much faster than what the economy is growing. And that quite clearly leads you to a budget problem going forward with bigger deficits and debts. We know that they're forecast out for a decade, and really an over-reliance in many ways on PAYG workers keeping their jobs.
Well, that's right. So the budget's in deficit already. And I think the challenge here, or there are multiple challenges. One is, as you describe, there is too much spending relative to the amount of tax revenue that's coming. So there are always three solutions to this problem. You either slow down the spending, you find more tax revenue, and that's one way the system works because the tax system is not indexed. So you move up tax brackets and get more tax revenue, or you grow the economy faster. Now, that is the best solution. Lifting productivity is the way to solve all of these problems. The challenge is, of course, we aren't doing much to lift productivity, and that's the challenge that's been set. I think the other thing to keep in mind is the government currently is assuming, actually, that productivity growth will go back to its 20-year average, 1.2%, in its budget estimates. We'll see at the mid-year fiscal update we get next month whether they're still assuming that, because it's very, very much higher than I think is reasonable and higher than what we're assuming and, of course, what the RBA is assuming now.
Well, see, that's the thing. We do get this budget update in December, the mid-year economic and fiscal outlook, MYEFO, as people call it. But the reality is the forecasts in there are going to be key for inflation, for economic growth, for unemployment, and for productivity. These are going to be the key ones to watch.
That's right. And I guess one of the big questions I have is will the government continue to be assuming? Will the numbers continue to be that they're assuming 1.2% productivity growth? Because that's what has underpinned the budget to this point. But of course, we're running at the moment. I mean, if you look at productivity over the past year, it's zero. If you look at what it's been over the past decade, it's running at 0.3. So where does the 1.2 number come from? And if you are factoring that in, that's going to make everything look a bit better than actually it is. The economy is operating at its full capacity already. And this, I think, is the primary reason the RBA is unlikely to be able to cut interest rates any further. If we want things to get better, we have to focus on productivity.
And the reason for that is because if the economy tries to grow any faster, or if they consider cutting interest rates, it's only going to push inflation higher, simply because the economy is operating at capacity.
That's right. We're operating already at the fastest growth we can have. Capacity utilisation is already rising. The unemployment rate's still very low. It's below what the RBA would call full employment. If you want the economy to grow faster, the RBA can't do anything about that. It's really all about fixing the supply side of the economy. And that comes back to all those productivity-related policies that we've talked about before.
OK, so the major story of this week, though, which goes to the heart of productivity, is Nvidia and these massive quarterly results that it's put out. But it wasn't just that impressed me, but it was also the presentation of its chief executive, Jensen Huang, about the future of the world in an AI, generative AI place. But then that is going to bring productivity gains. So is this where the government might get some hope that productivity starts to improve as a result of these computer chips and their great innovation? Absolutely.
So more use of AI is a pathway, a potential pathway for lifting productivity. And that doesn't just, of course, come from government. A lot of it comes from businesses' choices to apply AI. I guess the challenge at the moment is that if you look at how much adoption there has been in Australia, we're actually lagging. We're well behind other countries. We're actually pretty slow in terms of that AI adoption story. And so I guess this is an opportunity for us to move faster to adopting AI. But at the moment, it's not really contributing as much as it should be.
But that goes to the heart of planning for data centres, for energy, for water, for land use, for all of these things, to be able to take up those GPU chips, to be able to install those, to have them at an industry level, at a government level, to have it right throughout the economy, to get those productivity improvements.
I think that's absolutely right. And I think one of the ones you mentioned is a really important one, is getting energy in the right place. You know, if we're going to do all these sorts of things, we need to keep energy costs low. We need to have available energy to be able to make that happen. It's not the only story. We've talked about competition, industrial relations, the regulatory environment, and we need to look at the tax system too. But we need to make sure we've got enough energy to support a build-out that we require to support, for example, data centres and the AI story.
We've talked a little bit about the Treasurer, Jim Chalmers. You've often called him Lucky Jim because generally when things get a bit tough, something happens that's favourable to Australia, favourable to the government, favourable to the Treasurer. Normally it's a mining boom. There's no mining boom on the horizon. Given the forecast for the iron ore price, especially falling dramatically from here, is maybe the luck that the government's got, the actual productivity boom that does come from these AI chips.
I'm pretty sure I haven't described the Treasurer that way, but what I have described is the economy as having been very fortunate, very lucky, And we've been very lucky to benefit from China's emergence and the drive for demand that delivered for iron ore and coal and gas. And that was the success story over the past couple of decades. But I don't think it's going to be the success story going forward. China's growth is shifting. It's going to be more about consumption, less about building things. There's going to be less steel demand over time. And so we need to try harder, because if we're going to lift our living standards as much in the future as we did in the past, it's going to be all about lifting productivity.
Okay, then take me to one other aspect of it. We have a massive pot of capital in this country through our superannuation funds. And you've seen the Prime Minister even going and using this as a bargaining chip in the White House with the President Donald Trump. Now, the fact of the matter is that pot of money, that pot of capital, is going to be astonishingly valuable to Australia and Australians into the future. Is that another area where we may long-term get some genuine returns that do aid our prosperity in this nation?
Oh, it's wonderful that we have such a big superannuation system. I think that's a really big positive. We've got this big pool of capital that can be drawn upon. But as we all know, because we all hold superannuation, we want the return from that capital to be as high as it possibly can. The key question is investing in parts of Australia going to give you the best of those returns? And again, we circle back to the same challenge. The challenge at the moment is the cost base in Australia is growing too quickly because productivity is weak, and that's discouraging the investment, the business investment that we need to actually fix the problem. And so whether the capital comes from our own economy, from the superannuation system, or from abroad, doesn't really matter that much for the overall story, which is we need to lift business and we need to encourage a lift in business investment, because that's what's actually going to lift our living standards in the medium term.
I'll tell you, Paul Bloxham, always great to have a chat to you about these things. Many thanks for your time today.
Thank you.
Well, coming up after the break, the biggest story of the week, without question, were the quarterly results from the world's biggest company, the computer chip giant Nvidia. We'll hear from Nvidia's Chief Executive Jensen Huang and speak with one of Australia's biggest tech investors, Loftus Peak's Chief Executive, Alex Polak. It's great to have your company here on Business Weekend. Well, let's go to the markets, which this week hung on the fortunes of the world's largest computer chip maker, Nvidia. As it turns out, even Nvidia's very best performance in this latest quarterly sales report, $57 billion in sales, a forecast of $64 billion in the current quarter, it simply wasn't good enough. Share markets fell nonetheless. They got a bit back at the end of the week as investors questioned a payback period for the trillions of dollars right now being invested globally in the new generative artificial intelligence infrastructure, energy, and these new generation chips. Well, the man who best explained it this week, I think, was Nvidia's Chief Executive Jensen Huang, who spoke with Fox Business's Liz Clayman late this week.
One of the things that is really great about NVIDIA's architecture is that we're so diversified. You know, we run AI is not just one thing. It's not just one language model or one chatbot. AI is a system of models, and you could use it for, of course, chatbots, but you could also use it for physics and biology and chemistry and, of course, robotics and self-driving cars. And even within language models, there's so many different architectures. NVIDIA's architecture is the only one in the world that runs literally everything. And yesterday, we announced a big partnership with Anthropic, and now we're the only architecture in the world that runs every single premier AI model, as well as every single open source model, and of course, every single version, modality of model. And so our versatility makes it possible for us to have a lot of different customers. And for all of those customers, we can bring them a lot of other customers that ultimately use their cloud capabilities.
Yeah, it feels like all roads are leading to NVIDIA. How are orders for your next generation chip, the Rubin, trending? And are you still on track to ship them at the end of 2026?
Well, I announced at GTC that starting this year, because we started shipping Blackwells, over the course of this year through the end of next year, we have visibility of $500 billion worth of Blackwell and Vera Rubin. And we'll start shipping Vera Rubin in Q3 timeframe of next year. The silicon is back. It is working wonderfully. Engineers across NVIDIA are bringing up the system. It's doing it beautifully. And we're on track for volume production in the Q3 timeframe of next year. In the meantime, I announced that we have $500 billion worth of visibility, but in the last 30 days, we announced some major new wins that were not included in that $500 billion. So we have We're adding, of course, the Anthropic opportunity. We're adding Elon's xAI now being deployed in Saudi Arabia. We announced a partnership with Humane, and those GPUs have been licensed, and they're going to be deploying in Saudi Arabia. And we also announced that AWS is going to also build 150,000 GPU AI infrastructure in Saudi Arabia. All of those are all net new. And so orders are still coming in. And so it's going to be a pretty busy year for us the next year.
It sounds like then the current quarter is going to be crazy good. Can I say that? What do you think?
Well, we guided to a much larger quarter next quarter. And so the guidance that we provided is crazy good. I would agree with that. And but we're in the beginning of a very long-term build out of the fundamental infrastructure of humanity, which is computing. As you know, we reinvented computing for the first time in 60, 70 years. And so all of the computers that have been installed around the world is being modernized to accelerated computing, NVIDIA's GPUs, and to artificial intelligence. And so this build out is going to last us many years to come.
It was exactly a year ago, and this is why I ask about Rubin orders, et cetera, because it was a year ago that you and I spoke about the problem a lot of companies wish they had. Blackwell orders were pouring in from the firehouse so fast, demand outweighed supply. What specifically have you changed to prevent any bottlenecks when Rubin rolls off the Taiwan semi-assembly line?
Well, we're not going to be caught flat-footed too many times. And we now have a much better understanding of the scale.
Yeah.
And the breadth, the diversity of our customer base. We've done a really good job planning our supply chain. We now have the largest supply chain of any company in the world. We work with TSMC, of course, manufacturing in Taiwan, and then also very proudly, for the first time here in the United States, we work with every single memory vendor now. We have 3 different sources, 3 gigantic sources of really complicated memory, and every system maker in the world are partnering with us.
Well, the question of returns for investors, not just from Nvidia, but indeed for the whole tech sector, is now permeating the entire stock market, with most of the stellar returns posted earlier this year now being stripped away. So, how should an investor view the boom and now this retraction? Alex Pollock is Chief Executive of the Tech Specialist Funds Manager, Loftus Peak, and joins me now. Alex, always great to get your perspective on this sort of stuff. I mean, Nvidia, they could not have done better with that sales report they brought out, but it was not enough to maintain or reassert any sort of a sense of control inside the stock market.
Yeah, I mean, investors have just got the jitters, and they've got the jitters about a couple of things. One of them is that guy that sold out ahead of the big, that movie in The Big Short. He sold out of his shareholding in Nvidia a couple of weeks ago, and there's been a few other sellers, and people are starting to sort of, get their hairs on fire about whether the capex of $1 trillion is going to be serviced by the revenue that comes in. And everyone's kind of going, it's just all getting too hard right now. I don't know what to think about this. So it wouldn't matter what they posted, I don't think. The investors have got it in their heads that they need some more time to process this. And honestly, I think this correction's a bit healthy, because they need to process it, right? It's a lot to process.
And it's also a lot of money that's having to be committed, not just, say, in the chip makers or in the data centres that are being built right now, but it goes to every business on the planet that's having to commit to GRU chips to modernise their own businesses. And of course, everybody's now saying, when's the payback? What does the payback look like, I guess?
Yeah, I mean, people are looking for that killer application like email was to the internet, and they're sort of saying, well, I don't know what it is that I'm going to be using, AI for. But actually, if they sort of really think about it, they're using AI every day. I mean, it's a spell correct on your typing, and it's the, I went in, I had a consultation with my doctor the other day, and she ran the AI over the top of it. She asked me, and as I left, she had all the scripts just banged to my phone instantaneously, and the referral letter to the specialist all done. So she would have had to have, if she's seeing 20 patients a day, that's $50,000 or $60,000 a year she would have to pay for an administrative assistant. to be able to do all those scripts and all those little jobs that AI just picks up and does for you. People are sort of saying, yeah, but I don't have that particular, necessity for, to write scripts for AI. But AI is different for everybody. It's like a Swiss Army knife with a billion attachments. You might only use one, but you can't buy just that one attachment for the Swiss Army knife. Everybody's got a single reason for wanting to use AI. All those reasons are different, but you can't just say, oh, I only want this bit of it or that bit of it. It all comes out of one central idea, which is this, language model that predicts what's going to happen next. You can't strip out this bit from that bit from that bit. It's sold as a package.
I was really fascinated listening to Jensen Huang, but also listening to his analysts' call this week. I thought it was really instructive in where the future goes. He, better than anybody else, justifies the trillions of dollars that will be invested into this to really make these chips faster, to make them more interpretive into the future, to basically do more of these basic jobs that you're talking about. And the payback doesn't necessarily come to this company or that company, it might, but it really comes to a whole economic view of the world, I guess.
Yes, that's 100% right. What investors are nervous about is it's all come in a rush, right? 2 years ago, nobody had heard of AI, and then all of a sudden, there's trillions of dollars of money being committed all over the place, and people are correctly so to some degree, and people are just going, well, hang on, I'm a little bit, I'm not comfortable with this as it stands right now. Give me a minute to process it. That's what this correction's about, I think.
So give me a sense of the investments that you're sort of now trying to calibrate as to which have the greatest opportunities, because it's my sense is that the data centres, the chip makers, they're effectively just building the infrastructure. It's what comes off the back of that. That's where the genuine advancements come from in the future. That's where, if you like, the genuine money is going to be made, regardless of what sort of a clawback we get right now.
Yeah, I mean, and for those, specifically around that question, right, the obvious and the sensible way to play it, and it's one of the ways that we play it very, carefully and on an ongoing basis. We own Microsoft, we own Google, and we own Amazon, and we own those companies for their position as hyperscalers serving businesses and consumers, and people don't even necessarily know that they're using the cloud when they're watching Netflix. Why would they? But they're using those businesses to serve AI. And so the point about it is those are the businesses that wholesale will be buyers of AI. And that's one of the ways that we are playing it through the Microsofts, the Googles and the Amazons, because they're the principal, as it were, servers of the AI services.
So you are an active funds manager. You try and pick these opportunities, see where they might last, see where there might be some value for the longer term. But a lot of people play it differently. They simply go and buy the exchange-traded funds for the NASDAQ composite or whatever it might be. So if there is a flyer that is unexpected, they pick up a little taste of that. The problem is when markets reverse as they are now, they also pick up the downside.
Well, that is correct. But we're an ETF. We're an exchange-traded fund ourselves. So this, correction has resulted in a 5-6% reduction in the value of our shares. We're not bleeding out here, far from it. It's just we're a diversified fund as well and we're trading as an ETF, and our unit price on the ASX, on the stock exchange, has come back, as it were, in the last 3 weeks from 580 to 540. I mean, it's not great, but it's hardly calamitous.
And so the reality is, are you still finding people wanting to put capital in? That's the key to these things, isn't it? Because, of course, if there's capital coming through the door, you've got to expend that capital. You've got to find these opportunities.
People have been hanging back on the sideline for months, waiting for a moment when they think it's going to pull back. I know we've got daily inflow coming from investors that are saying, oh, here's my moment. It's come back 5, 6, 7%. now I have a chance to get in. We see those flows on a daily basis, and we're not surprised by it. And as you say, those inflows we must deploy into the companies that you talked about, we talked about.
The thing that also got me about Jensen Huang, and it gets me when you hear Elon Musk speak or some of the other chief executives of the big tech companies, the far-sightedness with which these executives are thinking right now. They're playing a game that is almost many decades into the future for where they think their technology will change the face of the earth. I think that's one of the things that really gets me listening to Jensen Huang this week.
That's 100% right. Nobody had heard of a large language model. People understood that machine learning was all around us 5 years ago. We first bought Nvidia ourselves, Loftus Peak Fund. We first bought it in 2016 at an adjusted price of 75 cents. You know, it was obvious that there was a whole lot of machine learning going on. The large language model that was developed over the course of 2020, 21, 22, we were watching where that was going. And it was quite, you know, what it is, the large language model is it's a probabilistic thing that based on everything that's happened before, what they call the training, predicts, as it were, the next word that will happen. And the example I give sometimes is, you know, that sentence they use to train you at school to write properly, the quick brown fox jumps over the lazy. You punch that into AI and 99% of the time it'll come out with the word fox at the end of it, because that phrase, quick brown fox jumps over the dog jumps over the lazy fox, has every letter in the alphabet, and that was what was used to teach school children how to form every letter. So all that the AI is something that predictively says, these are the things that happened before. The most likely word that happens now is the word fox, based on everything that I have learned from my training. It's simple in a way, but the maths is stupendously complex. But the underlying principle is not difficult.
I'll tell you what, it's always fabulous to talk to you about these things. Alex Pollock, the Chief Executive of Loftus Peak, many thanks for your time today.
Thanks, Ross. It's been a pleasure.
Well, coming up after the break, we take you to another industry that knows plenty about investing billions of dollars of capital and hope of future demand, international airlines. And we speak with Cathay Pacific's Chief Executive, Ronald Lam, on Hong Kong's future as an airline hub and why it keeps expanding in the new routes, the latest of which is Adelaide. Thanks for being with us here on Business Weekend. Well, the global aviation industry is right now seeing massive investment, from airlines upgrading to new technology aircraft that fly further and fly cheaper, to strategies that let them fly anywhere in the world without stopping. It might be Qantas's Project Sunrise or the new national carrier in Saudi Arabia, Riyadh Air. Tens of billions of dollars are being invested. One airline that's joined in is Hong Kong's Cathay Pacific, which now flies to 100 destinations. It's a clear sign of confidence in the Chinese-controlled island state. And this week I spoke with its chief executive, Ronald Lam, as the airline returned to flying direct to Adelaide.
Yes, indeed. We are very confident about the future of Hong Kong as an international aviation hub. And over the last 3 years, actually, we've committed well over 100 billion Hong Kong dollar into the future in building the Hong Kong International Aviation Hub. Most of that spend is on new fleets, but we also spend a lot on our cabin products as well as lounge products.
So this involves some, sort of 150 aircraft on order, including, and I should mention this, 35 of the 777-9. Now, we should explain these aircraft are bigger than jumbo jets, 747s. They're bigger than A380s in terms of their length. So you've gone for very large aircraft as part of your fleet renewal.
Yes, our future long-haul fleet will consist of A350-900, 1000, as well as 777-9. And I'm very happy that this year we've made an announcement for some additional order of 777-9, making the whole fleet will turn to 35 of them, together with close to 50 of our A350. So it will be a very scalable long-haul fleet for the future. And as with any fleet campaign, we have looked at different considerations before we make the decision. both on the technical side as well as on the commercial side. And I must say, I think this time is a very competitive campaign, and we have been very glad that we have selected 777-9 at the end.
Okay, so Ronald, just explain where you see the future of aviation from Cathay's point of view. You can see the Middle Eastern airline, even a new Saudi airline emerging now. They believe they're at the centre of the universe, as it were, with the ability to fly without stopping to any point on the globe. Just explain from your point of view the strategy when it comes to what travellers will want from Cathay in terms of international travel in the future.
Sure. We are very confident about the future of aviation industry, in particular in the Asia-Pacific regions. For the past decade, as we have seen, this region is the growth engine for the global aviation industry. And Cathay is right at the heart of this region. Our unique position is that we use Hong Kong as our hub to connect China with the world. And we are here to connect the world with China as well. So I think we're really well positioned for the future. And in terms of what customers will be looking for, I think first and foremost is connectivity. And through the Hong Kong Aviation Hub, we connect passengers from different parts of the world to more than 100 destinations worldwide. And we keep adding new destinations, like Adelaide this time is our latest addition to our network. The second thing is our premium service. We believe that apart from the connectivity, most important thing for our passengers is our service, both in the air as well as in the ground. And as I just mentioned, we have committed well over 100 Hong Kong billion into the future to upgrade that experience, for including our cabin products and our lounge products, our in-flight proposition when it comes to entertainment and dining, so that we can elevate the premium experience for our customers, so that more of them will be willing to travel through Hong Kong.
So when I speak to the chief executives of Air New Zealand or of Qantas, one of their strategies in going with the A350, the ULR flights, the ULH flights, ultra long haul, Project Sunrise. This is all about not having to stop in Hong Kong, not having to stop in Singapore or Dubai, where passengers may be cherry-picked to go and fly somewhere else. This is about going direct to a route. Just explain in those terms where Hong Kong, which has always been a hub, which means people need to stop there to go somewhere else, where does that sit in the future?
Well, we're still very confident about the future. I think one-stop products still have its position. I think traveling long haul, like up to 20 hours, is sometimes pretty challenging from a physical angle. So we do believe that there's a future for people wanting to stop. And many of our passengers, when they stop over in Hong Kong, actually they spend a couple of days visiting Hong Kong as a midpoint for their leisure travel or business travel as well. And when it comes to the Cathay strategy, because Hong Kong is pretty well positioned and we are able to fly to our major market without using the ultra-long range aircraft capability. For example, our longest flight right now is to the east coast of the US, which will take up to around 15 to 16 hours, quite comfortably using our existing aircraft without the ultra-long range setting.
So there's more emphasis in every airline on the premium cabins. Will you allocate more of your aircraft in the future to those premium seats? Because quite clearly that's what passengers are demanding, and you get the premium, as it were, for people who do travel in those classes. Is that where you'll put the emphasis in these new aircraft?
Well, we've been retrofitting our aircraft, and in the next few years, we'll have one new cabin product coming out, at least in each of the following years. And when we look at our new cabin product design, we follow the customers. So we study our customer demand for different cabins very carefully. And indeed, there's a trend of the demand for more premium travel, in particular for premium economy. So, for example, in our 777-300ER retrofit, we now have a larger number of premium economy seats than before. But I think we'll follow where the customer bring us, and we'll continue to study. If the customer demand more business class or premium economy, for sure our next generation product will follow that trend.
I mentioned earlier, Ronald, about the confidence in Hong Kong, not as a destination, as an airport for the facilities, but it also means that the economy itself there has to be strong. Its banking sector has to be strong. Its funds management industry has to be strong. Its racing industry has to be strong, horse racing. All of these things have been reasons why people have chosen to visit Hong Kong in the past, and they need to be reasons why people will go there in the future as well.
Indeed. Actually, I myself sit on the Tourism Strategy Board run by the Hong Kong SAR government. And we've been looking at different ways to develop Hong Kong as a tourist destination. And in recent years, actually, Hong Kong has got a number of new landmarks. For example, the West Kowloon Cultural Park, which features some world-class leading museums that has attracted tourists from the Chinese mainland as well as from international origins. And earlier this year, we have opened our Kai Tak Sports Park, which is a huge stadium that can host international events and concerts. And since this new landmark has been opened in the last few years, we've seen a lot of uptake on tourism demand, both from China as well as from international origins. In fact, many people in Hong Kong have been telling me that since middle of this year, there's a lot of uptake in terms of hotel demand, retail demand, dining demand in Hong Kong. And if we walk out to the street of Hong Kong, you can certainly feel the strong vibe of tourism has come back already.
Okay, then you mentioned, of course, starting flights into Adelaide. Tell me about Australia as a destination for Cathay. The reason for it is, of course, you've seen Turkish enter this market. Qatar now has more flights, according to its relationship with Virgin Australia. You've obviously got the domestic airlines. Most of the Chinese airlines now fly to Australia. To many people's observation, it is a very well catered for market. So just explain the reason that you have for trying to build more access points into Australia.
Sure. First of all, our relationship with Australia has dated back a long, long time. In fact, our first flight started in 1970, and we've been here in Australia for nearly 55 years now. And up to now, we have been flying to 6 new destinations in Australia, and Adelaide is the latest addition to our map into Australia. And on a weekly basis, we are flying to close to 100 flights per week nowadays. For example, Sydney, our biggest destination, we're flying 4 times, Melbourne 3 times a day. So it's a huge presence. In fact, we believe we are one of the biggest international airlines connecting Asia with Australia. So with all this long history, we are very confident about the future of connecting Australia with Asia and, in fact, with the world and China. So we see big demand. And it's not just about a quantity, because we can see a lot of Australian customers as well as Asian customers or customers from the Chinese mainland. They actually prefer our service because we have the best of both worlds, being Chinese. At the same time, we are also very international. So it's a great blending for our customers. So everything else being equal, we believe there's still very strong demand to choose Cathay Pacific service in and out of Australia. So therefore, we are very confident about the future of this market, and we continue to invest into new destination and new frequency into this market.
Ronald Lamb, Chief Executive of Cathay Pacific. Great to chat to you and have you on the program today. Many thanks for your time.
Thank you.
The federal government is almost adamant it can fulfil its target of 1.2 million new homes to be built between the start of this year and 2030. But in truth, it's already way behind its target. But the government is artificially stimulating demand by encouraging new home buyers to get into the market with just a 5% deposit. The lender's risk effectively is being insured by the government, which is a great strategy for buyers, but only if home prices keep on rising. Carly Chatfield looks at the impact of the government's first home buyers scheme on the capital city markets.
It has been almost 2 months since the government expanded its 5% deposit scheme to all first home buyers. The expanded scheme allows all first home buyers to buy property with just a 5% deposit, with no cap on the number of participants in the scheme, no income limits, and increased property price caps. Effectively, according to critics, the Labor government nationalised the existing private home lenders insurance scheme that has existed for decades.
What we are doing as of today is bringing forward our plan for 5% deposits. What that will do is to allow more young people in particular get into their first home.
In the past few weeks, Labor's Housing Minister Claire O'Neill revealed that first home buyers are taking advantage of the scheme. Of 57,000 homes sold in October, 5,778 were purchased using the government's deposit scheme.
Our program is now helping 1 in 10 get into a home of their own, and that's exactly what we hoped would happen.
Con Stathopoulos, principal and owner of McGrath West, Northwest and Hawkesbury, has seen a jump in first home buyer interest since the scheme started in October.
We've definitely seen an increase with first home buyers purchasing units in particular. So there's been a lot of activity around the apartment space, less activity in the housing space, but definitely the scheme has been working well since 1st of October in our regions.
For many first home buyers previously shut out of the market because they could not accumulate a large enough deposit, a door to property ownership is finally open.
I think what it's done is it's unlocked the capabilities where they would normally have been not able to come up with a 10% deposit, plus have to pay for lender's mortgage insurance.
But some politicians have raised concerns that the scheme is fuelling demand amid a housing shortage and surging property prices.
Labor's solutions are making the problem worse. They are pouring fuel on the fire with the 5% deposit scheme, which is increasing the price of entry-level housing and mid-level housing in ways that are punishing first home buyers.
PropTrack's October Home Price Index reported a spring price surge, with national home prices across all cities and regions rising 0.6% in October to a new record high, with the increase being attributed to this year's series of rate cuts, population inflows, and the expanded 5% home deposit scheme. Soaring property prices are forcing some first home buyers to team up with siblings to get a foot on the property ladder. After a 3-month search, Rolina Aboyd and her brother bought their first home together in Sydney at the end of October. Pooling resources helped them to break into the property market.
Me and my brother teamed up together to buy a home because obviously either one of our incomes alone wasn't going to be enough to service the loan. So obviously it would be a good idea if we both teamed up and bought something together rather than continue renting.
Even though they considered themselves savvy savers, ever-increasing home prices meant buying together was their only option.
We both have, pretty good jobs, and we've always kept aside a certain amount of money per month to just go to whatever savings that we wanted to save up for.
REA Group senior economist Angus Moore says that although the scheme is still in its early days, it should have a moderate impact on the demand for properties in affordable parts of the market, where first home buyers are typically active.
We wouldn't expect this to translate immediately into home prices. It takes a little while for people to apply for the scheme, get finance, find a home, and for then that activity to start showing up in home prices. These changes will clearly bring some first-time buyer demand forward and allow some first-time buyers to buy a bit sooner. That will have some impact on home prices, and that impact will be focused in the more affordable parts of the market where first-home buyers are a bit more active.
There are also concerns that the government is failing to take action where it really matters, such as tightening lending rules for property investors, leaving first-home buyers at a disadvantage and struggling to get their foot on the property ladder.
The housing crisis is in every country town and every city in this nation. And every Saturday morning, we see first home buyers standing alongside investors being outbid.
Investor activity accelerated in the 3 months leading up to October 1, with the number of new investor loans swelling to 13.6%. This lifted the share of new investor loans to 40% of all loans during that period.
We've definitely seen the return of the investor. So normally what we see is when the stock market or commodities markets are being impacted, they normally retreat back into property, bricks and mortar.
Many first home buyers struggle to compete at auctions, often losing out to investors with deeper pockets.
Auctions were very, very hard to attend to because I feel like you were constantly getting let down, especially with the people, the bids that were happening. There were some crazy bids.
First home buyers also often struggle with key hurdles when entering the property market, particularly when it comes to navigating the property purchase process.
I think that the major challenge that we've seen is actually understanding how to purchase property. So I'm talking about the legalities of contracts and changes and requests, but also more importantly, working out how to bid at an auction, when to buy prior, or how to negotiate. Also looking at what's involved with a property transaction through financing, building and pest reports, strata reports.
I feel like I had to rely a lot on my own research and my own, watching YouTube videos, watching, TikToks or whatever to kind of understand the process. That was a bit of a challenge.
So what exactly can be done to help first home buyers get their foot in the property market? Many agree that boosting the number of homes is key to helping buyers get into the market. The government has set an ambitious goal of delivering 1.2 million new homes by 2029.
And fundamentally, the only way that we improve housing affordability sustainably over the long term is building more homes where people want to live.
However, disappointing building approvals figures tell a different story, with the number of homes being approved each month consistently behind that goal.
At the moment, we're not really on track to hit that 1.2 million over 5 years target that the National Cabinet has set, in part because we're just not building as much higher density as we used to. There are some good changes from state governments to try and encourage that, but we're yet to see that really translating into completions on the ground.
Government policy could also remove hurdles by reforming and simplifying the property purchase process and help first home buyers secure their first home.
I think if you're a first home buyer, it's really aligning yourself with someone, whether they're a real estate agent, property conveyancer, solicitor, mortgage broker, anyone that's related in that space, to be able to actually educate on what and how to buy property.
Definitely education and simplifying it for people, that would be good.
Early data suggests the scheme has had a moderate impact on property prices. The government now faces the challenge of supporting first home buyers without adding further pressure to the property market, so they can purchase homes just like the ones behind me.
And that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course, you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.